Market structure. Higher high, higher low, lower high, higher low. The price may rise or fall, perhaps in a given historical period, but it does not do so perpetually. There are always fluctuations, and within these there are other, smaller fluctuations. So the price fluctuates, creating highs and lows. In a bearish market situation, i.e. falling, we will have falling highs and falling lows. In the example in the figure, we see how the highs are always lower and the lows are always lower. Thus, in a bearish market structure or bearish trend, we will have lower and lower highs and lower lows. Lower high, lower high, lower high, lower low, lower low. 40. On a bullish structure, on the other hand, we will have higher and higher lows and higher highs. Higher high, higher high, lower high, lower high, lower high. Structural breakout. When a high is broken, we are in a breakout situation, and price continues to make bullish breakouts. If the market breaks previous highs and creates new highs, while at the same time respecting previous lows, and creating higher and higher lows, then we are talking to all intents and purposes about a purely bullish structure. Breakout, minimum respected. 41. In a bearish situation, on the other hand, the lows are broken, then a breakout occurs, and the highs are respected. Maximum respected breakout. We take maxima and minima as our main structural reference. Usually, the best strategies are so-called trend-following strategies, i.e. those that follow the trend, rather than going against it. Statistically, these strategies are probably much more profitable, although this is not always the case, because the profitability of a strategy always depends on how it is constructed. If we are in a structural breakout situation, then we can distinguish it from a structural change. 42. Structural change. The structural change is a first signal of trend and structure reversal. It differs from the normal breakout, which is a simple continuation of the trend. If the price starts to make a bearish breakout again, it will most likely start a downtrend. As Wyckoff put it, this is the structural change, which many call change or change of character. The normal breakout is a continuation of the trend, while the structural change is the first sign of a reversal of the trend in structure. Structural change, change. 43. Strong and weak high. In fact, real markets are very different, so it is more likely that instead of a trend reversing like this, you see a trend that continues, goes up, then down, goes up again and down again, alternating. 44. In a situation like this, one has to be very careful, as there are bearish and bullish signals. The structure is much more complex, and two different types of maxima and minima are defined. For example, on a bullish structure, you could distinguish between strong and weak lows. If the price were to break a weak low, this would be an early sign of a potential retracement. In this case, you could start to sell a small part of the price. However, the closer one gets to the reference low, the greater the risk of the trend continuing, as a trend is much more likely to continue than to reverse. 45. On a bearish situation, the structure will be similar but opposite. We will have a high that is strong because it has managed to cause a breakout and a somewhat weak one because it has not yet managed to provide a breakout. Qualifying a breakdown, candle closure or wick. So far, we have drawn with a line, but of course, as we have seen, the graph is candlestick. So, as much as we can summarize it with a line, we end up with a candlestick chart. TradingView gives us the obvious option of switching to a line chart, but already switching from a line chart to a candlestick chart shows us much more. 46. Let us take this part of price action as an example. By drawing a line relative to the movement of the candles, we can see that there appears to have been a break. 47. But by selecting the line chart mode, the break is not visible because there has been a spike, or also called a wick, the shadow of the candle. So there was only a shadow of the candle having broken through the previous high. Wick, candle body closure. As we can see between the two charts, the candle body did not close above that high. The straight line above a candle is called a shadow. 48. Thus, if we use candlestick closures as a qualifying parameter of a structural breakout, there was indeed no breakout here. In fact, the price then dropped from there. Thus, if we are in a bullish trend and want to define a bearish trend, we would want the price to fall below the previous candle's low. In the example in the figure, you can see how a break of the lows is distinguished from a refusal to accept a price level. Acceptance refusal, but then, what changes between the two? A break without acceptance of the body below the minimum will have less value statistically than a break with acceptance, where the break also occurs with the body of the candle. 49. Thus, the break in the example on the left we call acceptance, where the price has accepted a certain level with the body. As in the example on the right, a one-level break with only the shadow, the wick, would be defined as a rejection. I refer you to minute 39 to 38 of the video on the channel, where you can see lots of graphical examples. Click here. As a first step, you should look at the graph, supplement this section with the video on our channel, and train yourself to identify the structure well. Kindly like, share, subscribe to this channel for more videos.